Greetings, and welcome back to the Rose Bros podcast. This episode, we are joined by Clay Seigle, Director, Global Oil Service at Rapidan Energy Group, a provider of energy research and analysis for investors, global companies, and policymakers. Clay has 23 years of experience in the energy industry with specific roles on oil market intelligence and trading strategy, with recent senior management roles at Vortexa and Genscape. Previously, he was energy segment lead at Maxar and served in several roles at IHS, including director of its Global Oil Advisory Service. Prior to IHS, Clay was Senior Oil Market Analyst at Enron and an analyst at the U.S. Department of Energy. Clay has lectured on energy security and geopolitical risk at events hosted by the Atlantic Council, the Baker Institute, S&P Platts, Thomson Reuters, and Argus. Clay has been a guest on CNBC, CNN, and has been interviewed in the New York Times, the Wall Street Journal, the Houston Chronicle, Bloomberg, and Reuters. Also, Clay earned his Bachelor of Arts in Government from the University of Texas at Austin and a Master of Arts in International Economics and Foreign Policy from the Johns Hopkins University School of Advanced International Studies. Among other things, we discuss oil prices heading to $90, energy security, market intelligence and signal versus noise, and the importance of a Chinese recovery for oil demand. Enjoy. This podcast episode is sponsored by Konate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Konate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info at konatewater.com or check out konatewater.com for more details. This podcast is sponsored by headracingcanada.com. Looking for high-performance ski gear this winter? In partnership with four-time Olympian Manny Osborne Parody, headracingcanada.com is offering the lowest prices possible through its online storefront by passing brick-and-mortar savings on to customers. Check out headracingcanada.com for more info and get your high-performance ski gear for the upcoming season. Good morning, Mr. Clay Seigle. Thank you very much for doing this.
Hey, Trevor. Good to be with you today. Thanks for inviting me.
For the listener, you are an analyst at Rapidan Energy, but for anyone that didn't listen to the episode with Mr. Bob McNally, to start from the top, what is Rapidan Energy?
Yep. Rapidan Energy Group is a boutique advisor on the energy industry and market. We cover a couple of key commodities, oil and gas, and all the regions of the world. But our expertise is we operate at the intersection of market dynamics and governmental policy and geopolitical risk. And we help our clients understand how all three of those come together to influence energy commodity prices and provide direction for the future.
What is your role at Rapidan Energy?
I'm the director of the Global Oil Service. And so we cover both crude oil and refined products around the world and advise our clients on supply-demand fundamentals, our proprietary outlook for those fundamentals and the price forecast, and as well, like I said, integrating those insights about how government policy and worldwide geopolitical risk are influencing the price of oil. Some of our clients are on the physical side, and so they are kind of the traditional oil companies you would think of, drillers, exploration and production, refineries, other what we call midstream, moving oil from place to place and processing it. And then we have sort of pure play trading companies, physical oil traders that are responsible for moving these barrels from supply to demand around the world. And then we also have our friends in kind of the paper trading markets. So hedge funds, investment banks, other strategies that take positions on oil and refined products in the futures and options market. We also advise governments as well. So energy ministries in certain countries and offices and departments around the world.
Just for a little background, how did you get into energy? Why the sector?
Yeah, that's a great question. I have to think way back on that one, but it probably goes back to my time in graduate school. And so just by brief background, I'm born and raised in Houston, Texas. So we used to call it energy capital of the world. I think it's now heat stroke capital of the world. I feel bad for my friends in Phoenix and stuff, but It's been a rough ride this summer.
Mm-hmm.
We're finally breaking below the hundreds this week. So it's been a long time coming. But anyway, I'm born and raised in Houston, so grew up around kind of the energy industry, but I wasn't really into it as a younger person. Went to undergrad at University of Texas, and I did a couple of early jobs out of school in sort of policy reporting and communications. I went to graduate school in order to specialize in kind of my passion, which is Middle Eastern studies. A lot of blood, sweat, and tears, metaphorically learning the Arabic language, and I'm really glad to have that under my belt. But I also got to the school that I went to for graduate, called Johns Hopkins School of Advanced International Studies. They're very big on the regional stuff, but they're also really big on international economics. And I came from a liberal arts background at UT, Texas, and this was the first time that I really studied the quantitative sciences. So about half of the program is international economics and related stuff. So trade theory, monetary theory. I took some corporate finance and classes in derivatives along the way. And I found I kind of liked that and had a little bit of an acumen for the numbers as well. So I'm getting this degree that's like half Middle Eastern studies, half economics and finance. And I'm thinking, what kind of career really combines activity in and love of the Middle East with economics and finance? And so for me, it was energy, and in particular, oil. And so while I was in grad school, I worked part-time at the U.S. Department of Energy and got to understand how they run their statistical branch and how all the reports work. And I came back to Houston, this is in the late 90s, with this kind of like aspiration of joining one of these oil trading desks that I had heard so much about. And this was kind of the rise of the merchant energy firm. And so I came back to Houston. I did some rounds of interviews. I wound up in a little small trading operation here in town called Enron. And so that was how I cut my teeth in oil trading and market intelligence generally.
To get into current events nowadays on energy, today's August 29th, 2023. Oil's hovering around $80. In your opinion, as we head into the fall, is that the ceiling or the bottom, or where are we at? Is it going up, down, staying the same?
I think a little higher from here toward the end of the year. That's our direction of travel right now. And the reason I say that is because unlike a lot of the skeptics out there, we think that global oil demand growth is going to come through in 2023. And so we think just a little bit less than 2 million barrels a day, year-on-year growth in oil demand. And so it's still resilient, it's still strong. To be sure, those macroeconomic headwinds have been weighing on this oil market all year long. And so we've managed to move a little bit higher in the last few weeks and maybe even month on the basis of it looks like the Western economies, the United States, Europe, are probably going to avoid that worst case scenario, the dreaded R word, recession. I don't know if it would be a technical recession based on the textbook definition of consecutive quarters, but a material economic downturn. It's still possible, but it looks like the Federal Reserve is probably nearing, if not already at, its kind of terminal rate for interest rate policy, and going to be able to engineer a not hard crash landing. Maybe not soft, maybe medium landing, but anyway, like avoiding the worst case scenario, like a 2008 repeat that saw a really sizable downturn in oil demand year on year, and certainly by the following year in 2009. So if that's a little bit off the table or greatly mitigated, we think that oil demand growth of about 1.8 million barrels a day is going to be enough to keep oil prices higher than we saw earlier this year. The other side of the equation, of course, is the supply side. And there, we're convinced that OPEC Plus, led by Saudi Arabia, is serious about tightening this oil market and kind of chasing out the naysayers that had been pretty prominently positioned in those paper markets that I mentioned a few minutes ago in recent months. But in the last couple of months in particular, those kind of bearish bets on the future price of oil have come out of the market in a considerable way. And we think that those paper traders are being swayed largely by that conviction, that determination from Saudi and its partners in OPEC Plus to create a real deficit between demand and supply in the second half of this year. Now, because the oil market was a little bit in like a supply crisis, the boy who cried wolf moment last year. Everyone was afraid that Russia was going to go offline in a huge way. It turns out that government and markets together found some workarounds to these new circumstances that enabled Russian oil to keep flowing. And so that was a boy who cried wolf kind of moment for the oil market. And oil prices unwound after that. So now what the oil traders have been saying in 2023 is, show me the tightening, show me the deficit that's actually building in the oil market. And then kind of like seeing is believing. I'll believe it when I see it. So long story short, we think that those traders are going to see it because OPEC Plus is delivering it in the second half of this year. Specifically, you've got these so-called voluntary cuts above and beyond the full OPEC Plus kind of policy agreement for these 9 members, if you include Russia. And then even above and beyond that is what Saudi Arabia has taken onto its shoulders unilaterally with a 1 million barrel a day cut above and beyond that. So they're in for a total of, I think, 1.5. It's the 1 unilateral and the 0.5 kind of the voluntary. So Saudi Arabia is withholding a lot of its oil from the market right now. Their exports are at a really low level historically. And that just shows the strength of their conviction to be there for the partners in order to tighten up the slack that was in the market.
Seems like oil's found a floor around $80, maybe $70 and could potentially go higher. But in your opinion, what's the biggest risk to that floor, if so to speak? Is it inflation being sticky and that we can't really get rid of it and the economy does fall into recession? In your opinion, to think of it from the other side, what's the risk on that?
Yeah, I'd say the biggest risk that we're thinking about right now is the risk of China not coming through with its contribution to that global oil demand growth story that I was just referencing. So in our outlook, the growth year to year in China, especially in 2023, is pretty material. It's about 2/3 of the world's total. And so the big concern right now is if China stumbles, if its recovery is, meets a lot of headwinds, if the recovery just doesn't take off there, then that could really take the wind out of the sails for total oil demand growth. And that would mean that those OPEC supply cuts are not really that impressive because there ostensibly will not be as much consumption as people are thinking will take place this year. But let's unpack that a little bit. I think that a lot of the skeptical traders have been right to note the fragility of the recovery in some elements of China's economy, and in particular manufacturing and housing. The data have disappointed on those fronts. That's fair. But where we think the naysayers are missing maybe the boat a little bit is on Beijing's determination to drive toward and achieve that 5-ish% GDP growth rate during this year. And we think that they're serious about that in Beijing, about delivering on that. And so they're going to do some things on the policy front in order to make that happen. One of the things they're going to do is they're going to apply serious fiscal stimulus to the economy that's going to benefit certain segments there. In particular, we think infrastructure, big construction projects around the country. And think about it. What is the fuel of the crane, the bulldozer, the equipment that goes into those infrastructure projects? It's diesel, right? It's middle distillates like diesel that are gonna be the beneficiary of that fiscal spending on those sectors of the economy. Secondly, transportation has really bounced back pretty well in China. We've been monitoring the kind of the rebound in transportation, both automotive, which is largely gasoline, some diesel, mostly gasoline, but then also air travel. And China has been going in kind of phases of bouncing back in terms of transportation fuel, and particularly air travel. So it started off on the domestic front, but I think even in the last several days, maybe a week, Beijing has announced the lifting of restrictions for groups to travel to a whole lot of international destinations. Quite a few dozen countries are now on the go list, whereas before they were restricted. So that's going to catalyze also a lot more incremental demand for jet fuel, which is another one of those middle distillates that I was talking about. So when we see those things coming through, we think that Chinese domestic demand for fuel for the construction projects and also for transportation is going to be there, as we've been predicting substantially all year. One last thing to think about for China, and a reason why I'm not too concerned about the downside, is Beijing's propensity to import more crude oil and export more refined products in order to help drive toward that GDP growth rate target, and also to generate a little bit of foreign currency on the side, which is an important priority there. We think they would like to have higher levels than they currently have. Let's put it like that. And so for all those reasons, they'll be promoting, or let's say incentivizing, the refiners to import more crude. So that's bullish for crude prices generally, and also to export more refined products. That's bearish for regional refined product margins in the APAC region particularly, but it does provide that outlet for China to kind of boost trade activity, and that's an important component of GDP.
It's hard to argue the sheer number of people in China in terms of the demand side, but on the supply side, coming from OPEC, some people would suggest that they're not as relevant anymore. Do you still think OPEC is relevant in terms of their ability to swing prices?
Well, in terms of their ability to influence prices through influencing the supply side of the supply-demand equation, very much so. Still quite influential. And one of the reasons for that is sort of their track record. And so it's true that in kind of a supply cut regimen in past episodes, there have been incidents of oversupply versus target, aka cheating on those targets or quotas. And that's one of the things that the naysayers say is, look, it's going to be every man or every country for itself when push comes to shove. But the truth is, the cohesion has really held. And this is one of those times when the cohesion is tested, because certain members of the coalition, and I already named Saudi Arabia, are doing more than you could say their fair share to shoulder the burden. But that really goes to the collective benefit of the group. Remember, OPEC Plus, this larger coalition that's brought in some of the guys that were traditionally in the non-OPEC side of the ledger into the kind of the coordinating coalition. It's been a success, and they've been able to guide the market toward where they want it to be in terms of, we spend so much time talking about the what we call the flat price, which is just sort of the front month contract price for oil that you see on the TV ticker or in the Wall Street Journal or whatever. But really what most oil traders traffic in is spreads, and particularly time spreads. And what OPEC has been successful at doing, and OPEC Plus since then, in the last few years, is keeping those time spreads relatively tight. And so there's a word that we use technically that we call backwardation, or a backwardated market, that just says that future prices are discounted relative to front month or current prices. That's a backwardated market. And that tends to disincentivize physical players from holding large inventories. And that's exactly what OPEC Plus wants to achieve, the disincentivizing of holding big inventories. They want those inventories to be ample in consumer markets, but not excessive, because excessive inventories are bearish for the oil market and cause traders to think that the market is oversupplied. If it goes down too far on that path, then that price curve, that structure that I was just referencing, flips into a different condition than backwardation. It's one that we call contango. And again, that's just a fancy word for meaning those deferred prices are at a premium to current prices. And that encourages that inventory building. The last time we saw a big contango market, you and the audience might remember, was in 2020, when you had this kind of double trouble of the pandemic hitting and basically screeching to a halt the world economy for a couple months there. And at the same time, if you remember, OPEC Plus did not have the cohesion. Saudi Arabia and Russia in particular could not agree on fair targets for all sides. And so they left a really important meeting just as COVID was hitting the world economy by saying, we just can't agree on supply targets. And so it's kind of everybody for themselves. That really only lasted for a couple of months. But during the time it did last, a really important historical, at least symbolic milestone was achieved, happened, whatever, where the future price of oil traded negative for a short period of time. I think that was April 2020. And it wasn't long after that sort of cooler heads prevailed and all the sides recognized that they need that coordination and cohesion among the producer group in order to achieve each one of their national kind of goals over the medium and long term. So they came back together and they got their act together. And ever since then, they've been able to heavily influence the oil market and recently tighten those spreads, keep backwardation within the market, disincentivize excessive building of inventories, and actually chase out some of the speculative shorts that had been lingering and building positions in futures and options. So OPEC Plus has to look at their report card now at the end of August and say, it looks like we're accomplishing the goals, but it's still kind of touch and go. China could disappoint, notwithstanding those arguments for the bull case that I made a minute ago. And it's possible that the Western economies could come derailed if interest rates are too high for too long. And so we get a real contraction in economic activity. So OPEC Plus has to be on alert for those conditions. And so as such, we think that they're liable to keep things a little bit tighter for longer, even more than they've already announced up until now.
Signal versus noise. In the oil markets, there's lots of noise. Everyone has their predictions on oil prices and their data points and what they like to point towards. But in your opinion, are there certain data points that seem to provide a better signal in terms of making oil price predictions, or what do you look towards?
Yeah, that's a great one. And I'm really glad you asked that question. In my career, I've had the opportunity to work on some of these alternative data sets, high frequency data, real-time stuff that wasn't really available when I started my career. And if you'll allow me, I'll just give a couple of examples of that. When I left IHS Markit after about 10 years doing a few different things, I was hired by the imagery satellite operator. At the time, it was called Digital Globe. Now it's called Maxar. And one of the things that we were looking at in those days was a smarter way to measure oil inventory levels by actually looking at the floating rooftop tanks and seeing how high or how low those floating roofs were going over time, and using satellite imagery to measure things like that to bring a more real-time view to the marketplace. That's now kind of a mature industry that's been around for quite a few years at this point. And many companies are utilizing that more high-frequency measurement of the tanks that can be measured. Not all of them can, but of the ones that can be measured above ground with the floating rooftops. That's been a real innovation in oil market intelligence that has brought transparency to the marketplace, because up until then, you could really only rely on trailing government data, and only in a few of the world's sort of advanced economies that even reported those statistics with any regularity and reliability. Now the real-time measurement of oil tank levels has become almost like table stakes for people that are playing in this field. So that's an important one. Yeah.
Energy security. I believe one of your areas of study was security and the importance of energy and how all the subjects work together. Charlie Munger might suggest that North America or the USA is better off keeping its oil inventories in the ground, and that oil is such an important asset that we should keep our own and import from other countries. In your opinion, is that the correct strategy, or how do you view it? Do you think we should be importing? Do you think we should be preserving our own inventories, or how do you think of that?
Well, I and Rapidan are huge proponents of energy security, but also of free trade. And so I'll answer the question like this. You really have to understand the United States energy industry and infrastructure in order to understand how feasible certain strategies for energy security are. So because of the way the United States energy infrastructure and oil infrastructure in particular is set up, it'll probably never really be possible to only rely on domestic oil for best results. One reason is because in the United States, we tend to produce mostly light, sweet crude oil. And only certain refineries are configured to produce a slate of refined products that the market needs with reasonable profits and returns using light, sweet oil. Most refineries need a combination of light, sweet, which means low sulfur, and also heavier and more sulfur-rich oils in order to produce that profitable slate of refined products. They could produce using only light sweet, but they'd be vastly underutilizing the very sizable investments that have been made over the decades in order to kind of maximize returns. So here in the Gulf Coast, where I live, which is the biggest concentration of refineries in the United States, they made big investments, these U.S. Oil companies, to import heavier and higher sulfur content oil, principally from Latin America, also from places like Canada and the Middle East, in order to monetize those feedstock products and convert them into the transportation fuels that we need here. So that's one reason why we'll always need some degree of imports if we're going to run those refineries the way they were designed to run. Another really important reason is because what we call arbitrage in the oil market. And that means that the products are priced differently geographically, depending on the supply and demand conditions in each region. What that means, we don't have to go into a whole detailed schematic here, but essentially it's much more profitable for the United States East Coast to get a lot of their gasoline, depending on the time of the year, from overseas than it would be from manufacturing it domestically. So presumably, if people want reasonable and even low pump prices in places like the United States Atlantic coast, importing of certain fuels like gasoline should be a part of the mix. And that's another reason why it's not really feasible to think about only having domestic energy supplies in order to have the best case outcome for consumers.
Consumers would like cheap supply from, I guess, for lower prices at the pump. But I guess the idea is that oil is so important that we should be using up other people's resources and leaving our own in the ground. It maybe isn't that black and white, but do you view it that way from a security standpoint, that we should be importing oil from other countries and leaving our own reserves in the ground because it's such a valuable resource?
No, we definitely not. It's not a case of leaving a feasible choice is to leave our stuff in the ground and import from the outside, or vice versa. We need both. We need both certain fuels, both raw feedstocks and finished products like gasoline, and in other markets like the West Coast, jet fuel from other countries in order to have the best outcome for our economy. At the same time, we also need to really maximize production of our own crude oil. And there's these associated liquids that we call natural gas liquids that are produced alongside crude oil that are really important for refining, manufacturing petrochemical goods, et cetera. And so in order to monetize that whole carbon chain and take advantage of the endowment of natural resources that the good Lord put here in North America, the United States exploration and production is a really important part of the mix. And our E&P exploration and production industry in the United States has had a lot of success in monetizing that resource for the benefit of American consumers. So we believe all of the above are necessary in order to have the best outcome for consumers principally, but also for the producing companies that are an important part of the American economy.
Canadian energy. This podcast is based out of Canada. You're from Houston, USA. From your perspective, how do you view Canadian energy? Do you view it as a risky political bet, or as a good trading partner, or as a reliable producer? How do you view things up in Canada?
Yeah, for sure. I mean, there's a lot of similarities between the U.S. oil patch and the Canadian. Some of the techniques for extracting the oil are different in certain parts of Canada. So we can talk about tar sands and SAGD and all the details. But at the end of the day, for sure, the United States and Canada are, important oil trading partners, and I foresee that continuing for a long time to come. Another thing that I did in my whistle-stop tour of what I think has been a really interesting and rewarding career is I worked for a sort of a tanker tracking and energy flows platform called Vortexa, which was based in London, and I helped start the U.S. office. But in Vortexa, you can actually identify what types of oil cargoes are on the ships that are transporting them. Now, I already knew about a lot of the Canadian oil that makes its way to the United States through my work at Genscape, because we were monitoring the oil flows by pipeline there. But the Vortexa information was really interesting because it shows how much Canadian oil is being exported by ships all the way down here in the U.S. Gulf Coast. Those cargoes originate up in Cold Lake and other parts of Canada. And so it really is an integrated supply chain that connects Canada and the United States, first of all, on the crude oil side, but also on the refined products to a certain extent. And it's one big North American market from that perspective. Reliable trading partners that have helped each other. I foresee that continuing into the future. Sure.
From in your own backyard, it seems like the politics and the political issues of the day are a huge deal. But from the perspective of someone from Houston, do you view some of our policies as backwards, or do you think they're progressive, or do you think they're the right track? Or how do you view some of the difficult policies towards the energy industry in Canada that we've experienced? Do you view them that way?
I have to admit, it's a little bit, well, you'll appreciate this, over my skis to maybe speculate on the efficacy of the policy landscape in Canada vis-a-vis energy as a whole. If you have some in particular that you're thinking of, I can try to comment on them. I benefit on our team at Rapidan by having several colleagues who are absolute subject matter experts in what they do. And one of them in particular focuses on the supply profile and policies in several of the producing countries. So if you have one in particular, I can try to opine on it. I'm not sure in the aggregate though.
Another problem with Canadian energy is that we feel like we're not getting the correct price a lot of the time, where particular natural gas goes down in the States at a huge discount. In your experience, Did you see that too? Or is it another worry that we have that maybe is blown out of proportion?
Well, it's true. I mean, you want to make sure that your resources are able to reach market. And a huge market for Canada is the United States, but there's other markets as well overseas. For Canada, it'll always be a priority to get its energy to market. Some of it can flow all the way through to the United States to export markets, but that's a long haul. And those arbitrage and transportation, what we call midstream economics, have to be there to support that environment profitably. Also important for Canada, we'll be continuing to export from both the east and west coasts to other continents, sort of transocean. So you need all those outlets in order to fully monetize what you have.
You're an energy expert. That's your job, is to predict prices and give advice. And that's what people, I guess that's the business model. But in terms of looking for analysis and insights, who do you look towards? Is there people or other companies? Where do you get your information from? Maybe your boss, Robert McNally?
Yeah, that's an interesting twist because, of course, we're always being asked for our insights on the energy market. Mm-hmm. When it comes to just being supplied with raw data, though, that is suitable for analysis, we certainly rely on our friends at the government agencies, and that's first and foremost the U.S. Department of Energy, National Energy Board in Canada, I guess the equivalent of our EIA, the Energy Information Administration. That's the statistical branch of the U.S. Department of Energy, and certainly depend on their weekly and monthly data releases in order to really understand what's going on both the supply and demand sides of the equation. That's on a lagging basis, but that's some of the best sort of truth data that's out there. Likewise, from many of the countries overseas that we analyze internationally, we depend on their own government's data to sort of feed our model and let us know what's been happening recently. So that in the OECD countries of Europe and Northeast Asia, and then in some of the non-OECD countries, the individual countries' government data can be very insightful and very helpful. Likewise, some of the big international organizations that monitor energy supply and demand can be useful parts of sort of the analysis chain. And so I'm thinking in particular of the International Energy Agency, the Paris-based group that was formed in the 1970s after the first international energy shock We're actually coming up on an important milestone from that 1973 anniversary this fall, this October, and from OPEC as well. The big producing coalition. They also put out a lot of interesting data that we take a look at and take into account when we're thinking about the markets.
Any analysts you like to look towards, or leaders in the energy industry that are providing good insights for you?
Well, a lot of the leaders on the corporate side are candid in their discussions when it comes to things like the guidance that they give on quarterly energy company earnings calls and their expectations for the future. So we hold many of those corporate leaders in high regard, and their teams, in terms of disclosing what the market should expect. I'm talking about new projects, project timetables, how to think about how that's going to affect supply and demand in future quarters and years. So don't forget about the corporate leadership side as well.
Well, that's a good sampling of questions, I think, from a Rapidan perspective, and I guess your role at the company. If you were to leave an investor coming into the fall with a insight on the energy markets, what might you suggest we covered pricing a little bit, but what would you leave the investor with going into the fall?
I would leave the investor with the medium to long-term outlook. And of course, at Rapidan, disclaimer, we don't give trading or investment advice. It shouldn't be relied on as such. Now, having said that, the medium to long-term outlook we think is very constructive for oil and gas investment. I'm going to talk about the oil side in particular because a lot of the conventional wisdom recently has been about a near-term peak in oil demand. And at Rapidan, we just don't buy them. It doesn't comport with our analysis of the data because the peak is supposedly predicated on things like leaps and bounds in vehicle efficiency standards. It's leaps and bounds in terms of market penetration of battery electric vehicles that are going to supposedly materially turn down oil demand growth in the near term, meaning this decade. When we look at the data, we just don't see those things happening big enough and soon enough to create a near-term peak in oil demand. Instead, we see oil demand in the medium term being quite resilient. Over time, over multiple years, oil demand should grow on a percentage basis around half the rate of GDP growth. So except for periodic recessions, which are going to happen through the economic cycle, oil demand growth is going to be more resilient than the recent kind of conventional wisdom would have people believe. The reason why this is important for energy investors is because when the oil market wakes up and discovers that conventional wisdom is wrong, that oil demand has hung in much greater than people had been expecting in years like 2023, when this discourse has been taking place internationally, there's going to be an aha moment. There's going to be a light bulb, an epiphany that says, I'm not sure that sufficient supply is going to be there to meet that medium to long-term demand. And it's entirely possible that OPEC's spare production capacity is going to virtually run out, and we're going to be running on empty on that front. And that is conducive with a much higher price environment than we've had so far in 2023, even than we're thinking we're going to have toward the end of this year as we push back toward $90 a barrel. That environment for the medium term is triple-digit oil prices. And so we think that's what the potential energy investor should be focused on for the medium to long term.
Awesome. Well, that's a great conversation. I really appreciate your time. Not that you need the exposure, but if anyone is listening, they can find you at rapidanenergy.com, I think.
Rapidanenergy.com, and we'd be happy to have them there.
Well, we can end the formal conversation there. Thank you.
Trevor, it's been a pleasure. Thank you so much for the opportunity to join today.
Thanks for listening, everyone. Hopefully you enjoyed the episode. If you liked what you heard, check out rosebros.ca, where we will have upcoming shows. Until next time, happy coffee drinking.